Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, today we're going to talk about something that could literally save your family a fortune. It's a tax strategy called Step Up in Basis. And if you own anything that's gone way up in value, stocks, real estate, whatever, you absolutely need to know how this works. So let me ask you, have you seen your investments just shoot through the roof over the years? And are you starting to wonder, how do I get this wealth to my kids without Uncle Sam taking a massive bite out of it? If that sounds familiar, you are in exactly the right place. Okay, here's what we've got lined up. We're going to start with a story that I think a lot of you will relate to. We'll call it Mr. Hong's Dilemma. We'll look at 3 choices he has, and that's going to reveal the whole key to this, the step up in basis. Then, we'll look at a pro-level version of it, see how it fits into the grand scheme of things, especially with real estate, and wrap up with one final really important thought. Let's get into it. To really get this, we're not going to talk theory. We're going to start with a story. And this is a situation that so many families find themselves in when they start planning for the future. So let's meet Mr. Hong. About 20 years back, he made a really smart move and bought some property. Fast forward to today, he's thinking about his legacy. He wants to make sure his kids get the full benefit of his hard work. And that means one thing, finding the absolute best way to pass this on without a crazy tax bill. Okay, let's look at the numbers, because this is where it gets real. He bought the place for $1 million. Today, it's worth $10 million. That is fantastic, right? But it also means there's a $9 million capital gain just sitting there, waiting to be taxed. So the big question is, how do you make a $9 million tax problem just vanish? So what can Mr. Hong do? He's basically standing at a crossroads with 3 very different paths he can take. Let's walk through each one and see what happens to his money. Here are his choices, plain and simple. 1, he can sell it and just give his kids the cash. 2, he could gift the property itself to them right now. Or 3, he could just hold on to it and let them inherit it down the road. And believe me, the tax outcome for each one is wildly different. Let's start with option 1. He sells. The second he does that, bam, he triggers that $9 million capital gain. After you factor in federal and state taxes, which could easily be, say, 30%, that's a $2.7 million tax bill, just like that. A huge chunk of that wealth is just gone before his kids ever see a dime. Okay, on to option 2, just gifting the property. Now, this seems clever at first because Mr. Hong doesn't have to pay any tax right now. But all he's really doing is kicking the can down the road. His kids get the property, but they also get his original $1 million cost basis. This is a super important term, carry-over basis. It means if they decide to sell for $10 million, guess what? They are the ones on the hook for the taxes on that $9 million gain. The problem didn't go away. And that leads us to option 3. Just hold the property and let it pass to his kids as an inheritance. Now, this might sound a lot like gifting, but it's not. It triggers a very special and very powerful tax rule that completely flips the script. Okay, look at this. This slide just lays it all out. Scenarios 1 and 2, that huge $9 million tax problem either gets paid by Mr. Hong or passed to his kids. But then you look at option 3. The capital gains tax for the heirs is 0, a big fat 0. How on earth is that even possible? Well, the answer is this amazing thing called the step up in basis. This is the legal principle that makes inheritance so incredibly different from a tax standpoint. Let's break down what's really going on behind that magic number. So here it is, the step up in basis. Basically, the tax code says that when you inherit an asset, your cost basis isn't what the original owner paid. It's stepped up to whatever that asset was worth on the day they died. The IRS basically hits a giant reset button. This image says it all, really. For Mr. Hong's kids, that $1 million cost basis he had, it's irrelevant, gone. Their new cost basis becomes $10 million, the value of the property when they inherited it. It's as if the tax man pretends they bought it for $10 million themselves. So here's the payoff. If the children turn around and sell the property for its current market value of $10 million, what's their capital gain? Well, the sale price is $10 million, their new stepped-up basis is $10 million. 10 minus 10 is 0. The taxable gain is 0. That entire $9 million tax problem has been completely, legally wiped off the books. It's a game changer. Now, if you thought that was powerful, just hold on, because it can actually get even better. For married couples in certain states, there's an advanced version of this that is just Wow. Let's check this out. So, this next level strategy hinges on a legal concept called community property. It only exists in a handful of states, but the rule is that most stuff you acquire while you're married is considered owned 50-50 by both you and your spouse. And that special status unlocks an unbelievable tax benefit. And this is it, the double step up. If an asset is community property, when one spouse passes away, something incredible happens. It's not just the deceased spouse's half that gets a step up. The surviving spouse's half also gets stepped up to the current market value. The entire basis of the property gets reset. This is a huge deal, and it's something you typically do not get with other forms of joint ownership, like joint tenancy. All right, let's zoom out for a minute, because this step up in basis, it's not just some standalone tax trick. It's the grand finale. It's the capstone of a huge, multi-decade wealth-building strategy, especially for real estate investors. Think about how this all works together. A savvy investor buys a property. For years, they use depreciation to get tax deductions. When they want to upgrade to a bigger, better property, they use a 1031 exchange to defer the capital gains taxes. They just keep rolling those gains forward, deferring. And what's the ultimate endgame? They hold on to the property until they pass away. Inheritance triggers the step up in basis, and all those decades of deferred gains can be wiped out forever. It's the final piece of the puzzle. Okay, but before we wrap this up, we have to address a really critical question. Given how powerful the step up is, does that mean you should always wait and let your kids inherit? Well, not necessarily. Here's the core trade-off. Waiting for the step up is all about saving on income tax for your heirs. But gifting an asset now can be a strategy to save on estate taxes. That's the tax on your entire net worth. See, when you gift something, any future growth of that asset happens outside of your taxable estate. If Mr. Hong thinks his $10 million property might be worth $20 million someday, gifting it now gets that future $10 million of growth out of his estate. So it's a strategic choice. Do you want to save on income tax later or potentially save on estate tax now? And that leaves us with the final question, the one you have to ask yourself. When you look at your own portfolio, your family situation, and what you think is going to happen in the future, which path is the right one? Gifting or inheriting? It's a complex decision for sure, but now you understand the powerful mechanics of the step up in basis, which is truly one of the most important tools you have for planning your family's financial future.